Good day to one and all. This is Dr. Sivaraman of iknowindices.com. I'll be presenting once a month the twin webinar, what I do on monthly basis, tracking the forex market together. So I give it in two parts. Part one is between 8 and 8:45 GMT of today, 18th November. So it is a simple live market tracking technique using the live market code page and also effective trading strategy. I'll explain to you the effective trading strategy using the hedging so that we will be in a position to track the market live and take appropriate positions without having much of an emotional attachment. As a result, you will be in a position to consistently earn money from that other market. So on a weekly basis on Mondays, I give Asian session live market analysis on Mondays during the Asian session. During that time, I give the forecast for that particular week. And I also insist that the trading strategy is vital rather than that of the forecast, because whatever the forecast we try to give, the market can respect the forecast or it can deviate from it. Nobody can go and stop it. So market deviations from that other forecast is bound to happen whenever the traders take one-sided positions. There comes the biggest problem, because when the players create the market sentiment, then all the traders go and take one-sided positions. After the big drop and find that euro does not have a strength to go up, then all go and take sell positions without asking a simple question. Okay, we are all selling. Who is that fool buying in the market? If they question it, then they will be cautious and they will not sell after the drop. So what happens when all the traders go and take sell positions? On last Friday, what happened? They quickly gained the levels in the case of euro and GBP, and then they continuously gained the levels on Monday, yesterday. Then what happened? The forecast says that they are supposed to hold on Monday the whole day on the upside and start making the dip on Tuesday. But before that, all the traders started taking the buy position after the rise at 1.25 and above in the case of euro and 1.57 and above in the case of GBP as a breakout trade. So when predominant of the traders have fallen one-sided, showing their head mentality, changing their bearish to that of the bullish mode without understanding after the rise why we should buy. And yesterday, during that of the Asian session live market analysis webinar, I was giving the forecast and also explained that they are expected to make a rise and then the slide and then dip and firm up. But they made the dip, could not raise the market at all because the traders have predominantly taken the buy positions at the higher level, and during the drop, they are not selling. So all through that of the US session, they have been holding near the low, and automatically those who have taken the higher level longs liquidate. And there comes the importance of trading strategy. If somebody would have hedged the position and the market would have dropped and kept stop at entry, now today market is coming back to that same level, to that of the higher level, and they can just stop out at that of the entry and continue the upward trade. So there comes the importance of trading strategy, which will eliminate the fear. Otherwise, what happened? Then yesterday when they made the drop, in the case of euro, about 70 to 80 pips from that of Friday closed level, and about 1.2577 was the high, they dropped it to 1.2447, about 150 pips. They made that drop, and immediately that would have given the fear to that of the traders that probably the market will be bearish. So immediately they would have liquidated the long position because they were afraid of carrying it to that of the next day. Then what happened next day? The players started gaining the levels. So this is what happens in the market. And the traders who have just liquidated the long position hesitate taking a fresh buy position because they have the inherent fear that they have already made one loss in the trade. So they do not want to take further loss. Instead, they will simply wait for the market to drop so that we will take a buy. But the players may not make a drop. So ultimately, what we need to understand is what is the intention of the player. This is a man-made market. As long as the market is man-made, then the men have the control over that of the market. Unfortunately, a handful of people have got a total control of the market, and they are in a position to make whips or moves in the market with their money power. As a result, you come across that they create the bearish sentiment, and when all the traders liquidate the long position, they gain the level. When the traders develop the bullish feel and start buying it at the higher level, they mercilessly drop and induce them to liquidate the long position. So ultimately what happens, the traders follow the technicals and find that, okay, let us better do the breakout trade once the resistance turns support, and when it acts as a strong support, then the traders go and buy it. Then later on, the players dump it, telling that fundamentally euro cannot go up. Then it comes down automatically, the trader stops out. Then the very next day, the economic condition of Europe and UK have changed. So second to second, the economic condition is bound to change in the countries. No, that is what the market says. And if you ask the economist, they may not say that. But if you ask the market, yes, second to second, the economic conditions of the countries will change and the prices will fluctuate. If you go in the morning and buy something and go in the afternoon and buy the same, the price might differ, and this sort of impression the market creates. So ultimately, it is a false situation which is created in a market, and simply people are all being misguided and people are all being under the grip of emotions. As a result, they think that, okay, when they are rising, then the trend is our friend, we will take a buy position, but the players drop it. When they drop it, trend is our friend, take a sell, then they rise it. So what to do? This is what the question. So ultimately, we have to keep our understanding as simple as possible in order to find how exactly we can consistently trade and earn money from the market. See, as long as the forecast are concerned, forecast is nothing but the prediction. So we expect the market to go up, or sometimes the market can come down. We may use various techniques. We may use various methods by which estimating whether the market will go up or come down. And in the process, we take into consideration only the available source of information, like what is the earlier levels, okay, how exactly the levels could continue, and how exactly the linear regression might follow, or what is the moving average during that particular time. So available information we try to gather and try to give the prediction out of that. But the actual available position, what is required is how the traders have committed their positions, whether the traders are net long or net short. And that many of the websites say that our traders are long, our traders are short, and things like that. And they are all nothing but the exaggerated information and not the true picture. I do not want to go into the details of it. So invariably, you find that those informations are not giving the right guidance. So ultimately, we have to find out whether the traders are net long or net short. So we need a method to do that. So let us not ask somebody to give us the information. We should be able to read it from the market by ourselves. Okay, there is a fight between the traders with that of the players. The players are here to give small profit for the traders when they find the trend is their friend and try to commit position, give 5-10 pips profit. So then the traders think that, okay, I can do this sort of trade, sell and buy. Whenever there is a pullback, it is a dead cat bounce back. So I'll take a sell, then it'll drop and I'll take a buy position. I'll buy back the position. So that way they will try to do the small swing trade or scalping. And when the going is good, then they as human become emotional and commit more positions. Instead of 1 or 2 lots, they commit 10 lots, so that when they drop 15 pips, if they take in 10 to 15 lots, it will be easily 100 to 150 pips profit rather than just taking about 15 pips profit. So when they increase that volume, then suddenly become surprised that the market has turned against them. And then immediately they have to go in for a stop. When they keep the stop, and the stop will take out much more than that what they earned during the scalping, small scalping to start with. So they are afraid and they avoid keeping the stop. Instead, they try to average the trade, take further higher level sells so that the average will go up as the market goes up. And when the market comes down, probably they will be able to liquidate. But when they commit more positions, what happens? The usable margin is also getting eroded because of over trading or committing more positions. And then beyond certain point, they find that the account could get margin call. Then immediately it is not the technical which is going to help, which is the crisis management. The trader decides, okay, let me close all the positions and relook into the market, and it is not appropriate because it might bring in the margin call. Even though the equity has come down, there is a fear of margin call. He has not taken any trading strategy to limit the risk. Instead, he take a blunt decision of closing all the positions. Then after about 10-15 minutes or 1 hour and 2 hours, they find that he was the fullest person on the earth and closed all the buy position at the bottommost level. Afterwards, the market has not dropped. What was the fear? If the market drops further down, there will be a margin call. He has liquidated all the long positions, but he finds that the market has not dropped. So yesterday, euro came down to 1.244447, and then it stopped and holding in that area throughout US session. And they made only a 3-pip downward dip and then started gaining the levels today. So if you just liquidate out of hurry all the positions, that means you have not had any trading plan. So if you'd have used the hedging, and if the hedging is making loss for 30 minutes, and immediately you could have understood that, okay, the hedge got filled at the lowest point. Afterwards, the hedging is not making profit. So I can just close the hedging with 1 or 2 pip loss or stop at entry so that I don't incur any loss. Instead, I will hold the original position, keep another hedge order slightly below the market, 10, 15 pips or 20 pips. And then when they start gaining the levels, again, I will participate in the market. So that way, if we try to use the hedging, we can avoid such calamities. So that is the most important thing in trading. First of all, when you plan to earn money from that other market, see that you don't lose money just like that. In the process of earning money, if you lose the money, that means you are foolish. If I tell anybody that you are foolish when you are losing money, you will just slap at me. You will simply say that I have followed all the technicals and fundamentals, and market is bound to behave like this. Market is unpredictable, and this sort of things is bound to happen. Fine. Okay, what are the contingency plan you have, sir? In the event if the market goes against, okay, I got the stop. So fine. Keep stop. 30 pips, 50 pips, 70 pips, below that of the suppose, above that of the resistance. Okay, fine. All stops are placed when 2 or 3 times when the stops are filled, you find huge equity erosion happens in the trade. Then ultimately, you find that, okay, using stop is not the solution, because you estimate that market may not turn around for about 90 pips or 100 pips or 120 pips and keep stop there. Okay, many would have taken a buy position yesterday around 1.2517. That was the low, yesterday's initial low, and kept the stop around 1.2460 and below that, thinking that, okay, market cannot come down there. What happened? The players dropped the market exactly below the stops because they know where the cluster of stops are there. What is the big advantage of keeping a stop? If your stop is known to the other players. Instead, if you use the hedging order, then what happens? Okay, when I use the hedging, and if it is hedged, I can close the hedging. There is no need to close the original position if the hedging is making loss. And on the other hand, if the hedging is continuously making profit, I can close the original position and start earning on the hedge side. So that sort of opportunity you get when you use the hedging. So unfortunately, what happens, people wanted to ask all the analysts whether the market is bullish or bearish, but nobody asked, okay, what is the trading strategy I should use so that consistently I'll be able to earn money from that other market. So that is what I was telling in many of the webinars now. Many of the analysts focus only on the technical analysis and trying to give the forecast. My humble request will be focus on the trading strategy and educate the people with regard to the trading strategy so that they'll be able to protect their account. And simply telling that 95% of the traders are losing money in the market is not a great deal. And we are not the analysts to make a propaganda of such statements. We are the analysts to give solutions for such conditions, what you come across in the market. So let us do the market study now. Today is 18th. The market is expected to make a small dip during the start, but yesterday itself, they just made the dip, and that happened to be a drop, and later on they did not form up during that of the European and US session. So as a result, the dip was compensated, and they have not made any dip. They made only a small swing in all currencies, started making the rise. Now you come across Euro and GBP are positive net change. Now, here is the European session. So what we will be doing during that of the European session. The forecast says that between 8 and 14 GMT, the market is expected to make a swing and form up move. Okay, so that means when it is going to rise, then we have to do a buy and sell trade. Okay, now look into that of the market. Where Euro is. Euro is closer to that of the high. GBP is closer to that of the high. So it is not the ideal level to take a buy position. And those of you know about the market, type of moves in the market, then during that of the gap time, between 7:30 and 8, they started breaching the initial high and gone above during that of the gap time. So that means what? Gap time moves or false moves. So they just quickly made the gains during the gap time, and once the session started, by 8 GMT, they started making the slide in Euro and GBP. Okay, let them make a slide. Okay, there is going to be a data release, and obviously you know that the data release times are used as trigger times by the other players. So what they are going to do. Now let us look into that of the initial lows and the highs, what they are set. This is what we do it. We take the forecast as a guiding factor and fine tune the forecast using the market trading technique. What is that market trading technique? We note down the high and the low set around 3:30 GMT in 4 majors and 2 commodity pairs. and use them as reference levels for the day to identify the type and the sequence of market moves. The players do it during the following sessions, and they are all tracked in relation to that of the GMT time frame. So market trading is mainly to note down the initial lows and the highs around 3:30 GMT. Now current time is 8:20 GMT. So what was the initial high and the low around 3:30 GMT and where the current market is, so that we'll be able to find out what sort of moves they are doing it in the market. So let us see that initial lows and the highs. In the case of euro, the initial low was 1.2444, just intact, not breached, and the high was 1.2476, but they went up to 1.2495. And during the gap time, they breached the high and gone above. And during first 20 minutes, they are still holding above that of the initial high. So when they hold above that of the initial high during the session, that means they wanted to make further upward move. And also when you notice that yesterday they just made a downward move, and the opposite move, they are doing it slowly from that of the low to the high. Slowly they have been gaining the levels all through Japanese session, and after the gap time rise, they are still holding above that of the initial high. And that means when they hold above that of the initial high for more than 30 minutes, they are likely to do an extended move for 2 hours or an intentional move for 2 sessions on the start of the third sessions. So I will explain to you in detail the type of moves with the help of another slide. So let us understand that euro is holding above that of the initial high. The initial high is 1.2476. And in the case of GBP, they are holding exactly around that of the initial high. 1.5656 was the initial high. They are holding around that 1.565558 level. And in the case of yen, 116.43 is the low, 116.79 is the high. They are closer to that of the high, but not breached the high. And also you find that when euro and GBP are showing positive net change, USD yen is also showing positive net change, whereas USD CHF and Canadian dollar are showing negative net change. That means before that of the European data release, they are simply handling the yen cross by making a small gain in the case of yen as a contrarian move, along with that of euro and GBP. As a result, you find that USD yen has not breached the high, even though when euro and GBP were rising, USD yen was rising. It was rising only about 5-10 pips and started making the slide. So that means they've gone up to that of the high and not breached the high, and they are expected to make the slide. And in the case of CHF, 96.30 was the initial low. They just breached it by 14 pips. 16 pips, 96.16 is the current low, and they are holding below that of the initial low. The high is intact, so they are likely to come down in the case of USD CHF. But USD CHF, the net change is lesser when compared to that of euro. So euro is making about 34 pips positive net change. The corresponding drop is not seen in the case of USD CHF, which is lesser. So it is not appropriate to take a sell position in the case of USD CHF, because we might not make a profit similar to taking a buy position in the case of euro, because our equity is precious and you have to daily do the analysis in which currency you can invest so that you will be able to get the money which should be the highest in the market. Then in the case of Canadian dollar, 1.1283 was the initial low, and they just breached and formed 1.1260, and currently holding below that of 1.283, still holding below that of the initial low. High is intact. And in the case of Australian dollar, the low is intact. The high is 0.8732. They just breached the high by 3 pips and then come down a little bit. And so here you find that predominantly predominant of the currencies are doing the USD weakening move. And still, they are in some cases above that of the initial high. In the case of GBP, it has come below that of the initial high. So after the momentum in the case of euro, only then GBP is expected to gain. So I explained many times that what is the currency which is going to gain first. The currency which is showing the highest net change is the first one to be handled by that of the player. So 33 pips positive net change in the case of euro, whereas 10 pips positive net change in the case of GBP, 9 pips positive net change, 13 pips positive net change in the case of Australian dollar. So they are going to gain levels in the case of euro, followed by Australian dollar, and finally GBP. So our priority in taking buy position should be euro today. So you should not refer to that of yesterday. Yesterday GBP dropped less, whereas euro dropped more. So out of the fear, if you think that euro may not rise more and you think that GBP is going to rise more, then it is wrong, because ultimately what you have to find out what the intention of the player is. So now we have seen the initial lows and the highs, and also the session timings we have to follow. The early and the late sessions, they handle the majors, and the mid sessions, they handle the crosses. And also they handle two pairs at a given time. And also the spread between the high and the low should be more than 40 pips in order to commit a position in such currencies. Only when the spread between the high and the low is more than 40 pips, such currencies will be making swings in the market, or they will be giving profit for you. Otherwise, if you commit a position, probably you may get 1 or 2 pips profit, and you might feel disgusted when other currencies are going up and your currency is not going up. That means you are not appropriately selected the currency. Many of the people, out of impulsiveness, choose the crosses because they think that the crosses are making more spread quickly when compared to that of the majors. But the risk involved is also great in the case of crosses. So one need to understand that trading crosses requires more in-depth study about that particular cross, because they make only the moves in the case of the majors in order to bring in the moves in the crosses. Like they are making a contrarian move. Euro is positive net change. USD-N is in positive net change. As a result, you find Euro-Yen is in positive net change. That is how they gain the levels and drop the levels, etc. Whenever they make the contrarian move like this, you'll come across big moves happening in the crosses. But whenever they make the USD gaining or the USD weakening move, you will not come across big moves happening in the crosses. So you have to identify when they are making contrarian move and then commit positions in the crosses. Because many of the people simply assume that, okay, when you take position in Euro-Yen or GBP-Yen, it is not influenced by data, or it is not directly related to US dollar. So it is better to follow only the technicals there and try to take the positions. And that is what many of the people think. And in such currencies, because of relatively less volume, the players make one-sided moves of 200, 300 pips in one go. So they are caught on the wrong side. And if they all think that, okay, Euro-Yen has come to the resistance, we can take a sell, then quickly they gained about 300 pips. How? By gaining more levels in the case of Euro, gaining more levels in the case of USD-Yen. That's what happened on Friday and also yesterday when they went up to 117. Then people were not in a position to withstand such a pressure. So small traders, when you think of trading in crosses, be aware of the consequences and then commit position. That's what my humble advice. Because, see, it is not the question of testing your risk-taking ability. It is a question of earning money from the market. And if you want to earn money from the market, you should have the mindset to earn. You should not have the gambling tendency, or you should not have a tendency to lose money and say that, oh, I can afford to lose the money. And that is not the attitude required here. The attitude required here is, no, I wanted to understand the market and I wanted to earn money from that other market. And then I wanted to understand as much as possible in the market without any prejudice, without any preconceived ideas. And I want to see how exactly men are manipulating the market and try to read it properly and try to trade along with them and make money, because I cannot trade against them because they have got huge money power and they can push the market upside or the downside without no reason or with excuses or with the rumors, which I cannot do. In such a situation, I can only read their intentions and try to trade along with them. For that, we use only the live market quote page as the tool, and no other tool is used, no chart and no other technical analysis, and try to find out what they are doing it in the market from time to time. So in that, we identify the type of moves they are making in the market. So basically, they make the 5 type of moves in the market, namely the moves which are happening in less than 30 minutes during that of the session start and the session close time. They make such stop and move. Above that of the initial high, they go up and come below that of the initial high in less than 30 minutes. That's what they have done it in the case of GBP. Whereas in the case of Euro, they are holding above that of the initial high 1.2476. If you note down the initial lows and the highs and from time to time refer to it, you will be able to understand. That means what? Anybody who has bought around 1.2450 or lower or above is in a position to comfortably book profit. Whereas those who have taken the sell positions are waiting. That's what it indicates. So why the players are holding above? They wanted to absorb all the sells because predominant of the traders have turned sellers. So they hold. And what happens? When they gain further levels following the technical or following the data release, immediately when they quickly gain the level, the traders who have gone short come for the short covering. At that time, the players give the positions to them. Simple. So they buy it at the lowest level and sell it at the highest level. But we follow technicals and say, okay, it is a sell level, we sell and get trapped because we fail to keep stop at entry. Then later on they go up and then out of fear go in for a short covering and the players sell it to us. So it is a question of when somebody is losing, some other person is gaining the level, but some other person most of the time happen to be the players. So if we trade along with the players, we'll also make money. There's no point in blaming the players, etc. Instead, we silently make money following the techniques of the players. Then they also make a false move. They come up to that of the high or low and without breaching the low or the high and then reverse the market in less than 30 minutes. And that they do it before that of the extended move or the intentional move. So in extended move, what they do, they come up to that of the low, the false move, and without breaching the low, they come up and breach the high and stay above there for more than 30 minutes. Then they continue to gain the levels. That is extended move. Extended move is also a quick move which happens only for 2 hours. Afterwards, they stop cutting the high and they simply hold the market and start reversing it. And if it happens to be the third session throughout, till the end of the day, they simply hold it. Then afterwards, they reverse that market the very next day. That's what happens. Now they are making the intentional move holding high. Then if they are making a slow move, all the stop and false move and the extended moves are quick moves. So they are all opposite to that of their intentions. That is why all quick moves in the markets are false moves. Not only in forex market, in all market, all quick moves are false moves. They trigger the fear among the traders by making such quick moves. And later on, when the traders go in for a distressed trade and they reveal it, but it becomes too late for the trader, already they would have accepted the loss. So simply people say that control your emotion without giving any solution. But what is the best thing? If you are a small trader and you do not want to be emotionally caught in the market, identify the intentional moves and trade only whenever you come across the intentional move happening in the market. That is, they set the low, not breach the low for more than 30 minutes, making only pip by pip gain from the start, early Japanese session or early European session. Then you try to take a buy and keep 30 pips hedge order. Still, you limit the risk by keeping the hedge order. And once they start gaining it, if they gain about 10 to 15 pips or 20 pips profit, shown is in the position, then you keep stop at entry and remove the hedge order. There the hedge is acting instead of a stop. And once the market goes in your favor, you remove the hedge order. Then afterwards, you wait till end of the session. During the late session, they will make further upward move. Then you book profit. Or you wait for 2 sessions and the start of the 3rd session, and slowly they will gain. So they have started gaining from Japanese session till the start of the US session. They will be gaining the levels today and afterwards holding high. So at that time, you can book profit when you follow the intentional move. So intentional moves are always slow moves. Then you will not be caught. And even if you keep the hedge order, your hedge will not be filled. And always try to find that if there are data release, then try to close the position before the data release. If you are not able to withstand the volatility they create, because they have to create the volatility, only then the traders will become afraid. The traders will also perceive differently in the market, looking at the lower level time frame charts. They will look for the 5 minutes chart and it will show it is going to come down. They make the moves in such a way, and when the traders commit sell position, they quickly zoom up. It is very simple to trap the traders because when they are all misguided. That is why you come across always when somebody wants to lift your purse in a public place. No, you will not be talking in a language in which you are all communicating. Suppose everybody is talking in English and then trying to go in a subway or in a railway station, etc. If a gang of people who are trying to loot the purse of some of the people, the travelers, what they will do, they will have the coded language, and also they will be talking in a different language and quickly lift the purse and pass it on so that even if you catch him, the purse will not be with him. So in the same way, and that is the lowest level of stealing money from the people. The highest level of stealing money from the people is operating the market. In the event if the position is hedged, what do? You wait for 30 minutes. If the position is not making profit, you simply close it and keep another hedge order. And that way, you will be able to prevent the position is prevent simply closing the position with using a stop. And in the event if the hedging is making profit, then you keep stop at entry in the hedge and wait for the market to go down anywhere they want. And later on, they will come and hit your stop at the entry in the hedge and continue upward move. Then you continue to participate with your original position. Otherwise, if you're a smart trader, when they make a drop and stop cutting the new low for more than 30 minutes to 2 hours, that means it becomes an intentional move. Then immediately close your sell position and keep another 30 pips hedge order. Like yesterday, 1.2445 or 47, you would have closed the position and kept 30 pips below the hedge order. And then you find that they are rising it upward now euro, then you can trail your hedge order in line with it of the rise, and later on where after the data release when they gain for the levels, you'll be able to book profit on the buy side as well. then you become a smart trader towards booking profit on either way moves of the market. Now coming to the trading in this particular session. So as I explained that euro is holding above. So when I was talking that I was also watching whether it comes down a little more. No, not at all. So they were holding it around 1.248485. So we will buy it at the market. But if you look at it, it will be the highest closer to that of the high. But still, they are holding above that of 1.2476. What you can do is, you can either keep a buy limit order 5 pips below and wait for them to fill it up. Instead, because the webinar, I have to wind up in another 5 minutes. So I'll try to take one position at least. So 1.2494 and 30 pips sell stop. $1.2464. Then in the case of GBP, I was telling you, okay, now it has come up to that 1.5656, that initial high. So you just watch whether it is going to stay above, but definitely GBP is also expected to gain level. They are only swinging here mainly for the data release, and later on they will gain the levels again. So we'll try to take a buy here, 1.56. $1.5629. Okay. Then in the case of USDN, I was telling you that they wanted to drop because they are not breached the initial high what they have set. So I'll take a sell position here, 116.68. So I'll keep a buy stop. $116.98. So at any position, we take only risk for 30 pips. That you have to keep it in mind. Just taking the risk only for 30 pips. And in the event if the market hits the hedge, you review that for 30 minutes. If you become a smart trader, in 10 minutes you will be able to read their intention, whether they filled your hedge during the stop end or it is just move against your expectations. We'll be able to judge it very easily. And then later on, you can handle that hedge, simply close it and keep another hedge order, or you can book profit on the hedge side. And again, if it is an extended move, after 2 hours, you book profit on the hedge side, sell side, and then keep another hedge order. They will start gaining the level again. Then you can book profit on the buy side. It is like yesterday, intentional move on the downside. Then wait for the US session start. When they make one more dump, you book profit on the downside. And later on, they start gaining the level. And again, what happened on Friday, they gained the levels during the US session and then continued to gain the level during yesterday's Japanese session. And from European session, they made one quick rise and start making the slide. So they are all called wide range swings. No, either way, they make the moves to confuse the traders and also to trap the traders. When they become bullish, trap it. When they become bearish, trap it. That way. So alternatively, when they become the losers, then the traders become cautious. Then afterwards, you find the market is simply holding for the data release so that the traders will come back to the market. So that is unfortunate situation in the market. So when the traders lose 3-4 times, they become cautious. Then afterwards, by making profit in 1 or 2 times, they become addicted to trading and start committing more positions and become over trader. And later on find that when the equity is eroded suddenly because of the wrong trading, then again they become cautious. So ultimately, in the process, what happens, the person who is not in a position to contain the equity and earn money, and he simply lose the erode that usable margin and continue to pump in as long as his capacity permits. And later on, you find he becomes great advisors through chat, through blog, etc. Because he does not have much more money to trade with. So it is a very unfortunate situation. And so that is why you come across so many analysts and so many are simply following without understanding why they are following such technicals, without understanding the basics of statistics. Now, simply they are applying it. That shows very clearly they become the analyst because they don't have any other goal. That should not be the condition. A person who is able to really perfectly understand the market and purposely able to guide the traders can become an analyst. Otherwise, we can do analysis for our own and try to perfect it. That is different. When you start giving to others, we have to be doubly cautious. And many of the people are not focusing on it. And simply they think that the disclaimer will protect them. That should not be the attitude. Okay, let me answer to the questions which are asked. So these are all the positions I have committed, and you can make a note of it and later on find out what happens by the part 2 of the webinar. So I'll come back by 15 GMT to give the part 2 of the webinar. I'll explain more about that of tracking there, and we'll also try to think about the trading during that of the US session. At that time, I'll also compare the initial lows and the highs with that of the US session, highs and the lows set in the market in Euro and GBP, etc. Then we will find out how the players are making the moves, whether it is in line with our expectations or against us. So that if it is against, we have got the hedging to earn money. And if they are making the move in our favor, we have got our own market reading technique, so we earn money. So that should be the approach. And consistently, we should be able to earn money from the other market. So let me answer to the questions which are asked here. Okay, any idea when to exit Euro? As I explained that when I take the buy position during that of the European session, early European session, I mentioned that the exit will be the late European session. Whatever be the level near the high, whatever the high they set, I'll try to exit during the late European session. European session gets over by 14 GMT. So before coming for the next webinar, I'll close the position and show you the profits, what I have earned. So there is one possibility we can keep 1.2497 as the exit, but it is very close to our entry. Just earning about 2-3 pips, that is not our objective. So we expect further upward gain because already they have gained 42 pips. After the data release, they are expected to make further rise, at least 40-50 pips. And then we will watch, and once they form the high and not breach the high for more than 30 minutes, we can close it during the late session or by end of the European session around 13:30 to 14 GMT, look for the upward stop and then close the position with a profit. Okay. Then Santoshini has got a question. I am very new to forex. Basic question: what I am newish to the forex? Your entry level were not keeping in any account. The trend is the correct. I'm not able to understand. Your entry levels were not keeping in any account. The trend is. I think he wants me to show a trade in a trading platform. Now, I am not done the trade in a trading platform. I am only just do a mock trade here. I am just entering the levels, just show whether those levels are showing profit or not. I'm not doing it for the sake of money, sir, to attract people or convince that I am giving the right forecast or right approach to the market. So kindly subscribe. I'm not doing any provocation. So I'm just trying to educate people or trying to create an awareness among that of the traders. Nothing more than that. So please differentiate me from others in any. If euro is going to rise, can we expect euro yen to rise? Okay, as long as they continue to make contrarian move, euro yen can rise. If euro USD yen is expected to make a drop, then euro yen will be making sideways move. Then will this being the main tracking strategy? Will has got a question. Is it to be coupled with currency conversion trade during trending weeks? Or yeah, you can do the currency conversion trade during the trending weeks. My best suggestion will be first week to last week of the month. So on the first week when euro becomes very, very weak, you try to buy. And end of the month, euro will become very strong when compared to US dollar. You just simply close it, convert back to US dollar. Conversion trade during trending weeks, or should we aim for one or two other strategies? So currency conversion can be done month on basis. And if you are capable of reading the market further, then you know that they don't do the hat trick I mentioned many times. Then when they can gain the levels for 1 month and not making any drop during that last week, that means they wanted to gain further levels during the next month. Then afterwards only they will make a drop. At that time you hold for 2 months and book profit. Then will, again another question, depending on if it is a trending week or a reversal week. That is what, the first week and the last week will be the reversal weeks. The rest of the weeks will be trending weeks in a month. Okay, so no more questions. So at the moment, what the positions I had taken, they are all almost flat because I had taken only now. It was making a loss of about 5 pips. GBP is making a loss of 3 pips because of the spread variation. And yen is making a loss of 1 pip or 2 pips because of the spread variations. Otherwise, the market is holding. So I'll come back by 15 GMT and show you what happened to these positions. So I have the entry levels and also I have the hedging order levels. There is a buy stop as well as a sell stop levels. And in the event if it is filled, how I handled it, I will give it in the form of a remark. And as it's straight, the position is making profit. Around 13:30 to 14 GMT, I'll close the position and show you what is the profit earned. So you will be able to see all the reactions and you can also track the market continuously and tell me whether I had done the right thing or not. And apply your common sense and you try to develop further based on these forecast and also the trading strategies. So ultimately, the trading strategy is going to make you a winner in the market and it is not the forecast. So thank you one and all. Thank you, FX Street. I'll come back by 15 GMT to give the second part of tracking the forex market together webinar.